There's something that almost never happens in the markets. And when it does happen, it doesn't end well. Gold and silver don't rise together by accident. Historically, when this happens, it's not a bull market. It's a warning. The problem is that most people only understand this warning after the damage has already been done. And now it's happening again. If you look carefully at the last 100 years of financial history, you'll see that when gold and silver surge simultaneously, something fundamental is breaking in the monetary system. This isn't a prediction. It's a logical consequence of forces that are already in motion. And today, we're going to understand why this matters so much to you, your family, and your financial future. We're living through a peculiar moment in American economic history. In 2025, we witnessed something extraordinary. Gold rose over 70%, and silver surged over 140%. For the first time in decades, these metals climbed together in a coordinated, persistent way. To most people, this looks like just another normal market movement, but it's not. If you understand the incentives behind precious metals, you understand they respond to very specific forces. And these forces, historically, appear when confidence in the monetary system begins to crack. Think of it this way. Gold and silver are like canaries in the coal mine. When they start singing together, it's because they've detected something in the air that we haven't fully felt yet. What they're detecting now is the gradual erosion of confidence in the US dollar as a reliable store of value. History is an excellent teacher, especially when it comes to monetary patterns. Over the last 500 years, every time gold and silver rose simultaneously for prolonged periods, it coincided with confidence crises in the dominant currencies of the era. In Germany, in the 1920 seconds, before the famous hyperinflation, gold and silver began rising together. People still didn't fully understand what was happening, but the metals were already signaling the loss of confidence in the German mark. It wasn't a speculative movement, it was financial survival instinct. When Nixon ended dollar convertibility to gold in 1971, gold and silver skyrocketed together. It was the market recognizing that the global monetary system had fundamentally changed. People who understood this early protected themselves. Those who didn't saw their purchasing power evaporate in the inflation of the 70 seconds. After the 2008 crisis, when central banks began printing money massively, gold and silver rose together again. The market was signaling distrust in extraordinary monetary policies, and this is where most people get confused. This pattern repeats because the fundamentals are always the same. When there's too much money creation, when there's too much debt, when there's too much leverage in the system, precious metals respond as an early warning system. To understand why gold and silver rise together during systemic crises, you need to understand three fundamental principles. First, the law of monetary supply and demand. When governments create money faster than the economy produces goods and services, each monetary unit is worth less. It's simple mathematics. Gold and silver cannot be created out of thin air. Their supply grows very slowly through mining. When the supply of paper money accelerates, but the supply of metals remains constant, metals naturally appreciate. It's like a seesaw. The more paper on one side, the higher metals rise on the other. The second principle is the reflection of confidence. Currencies function based on confidence. Confidence that the government will honor its promises, that the currency will maintain its value, that institutions are solid. When this confidence diminishes, people seek assets that don't depend on government promises. Gold and silver are exactly that. Intrinsic value, independent of policies or promises. This seems abstract until you look at your own bank account. The third principle is the leverage cycle. All economic systems go through leverage cycles. First, people borrow moderately. Then, encouraged by results, they borrow more. Eventually, debt becomes unsustainable. When the deleveraging cycle begins, everyone wants real liquidity, not promises. Gold and silver represent ultimate liquidity. Imagine a typical American family in 1970. John worked in a factory. Mary took care of the house and children. They had a house with a mortgage. some savings in the bank, and believed that by working hard they could retire comfortably. In 1970, gold was about $35 an ounce, and the average annual pay was roughly $6,500. That means a typical worker's annual income was equivalent to about 186 ounces of gold. In early January 2026, gold is around $4,400, $4,500 per ounce. If the average annual pay is around $52,000, that income is equivalent to roughly 11 to 12 ounces. That's the point. Gold measures long-term confidence in money. This is the kind of detail that rarely appears in the news. This happens because gold isn't just a metal, it's a thermometer of confidence in the monetary system. If you look carefully at current data, you'll see troubling signs that explain why gold and silver are rising together again. By late 2025, U.S. federal debt had moved above $38 trillion. And as that burden grows, so do interest costs, pressuring budgets and limiting policy choices. Interest costs have surged. In fiscal year 2020, net interest was about $345 billion. Since then, interest has climbed sharply and is projected to keep rising, tightening the government's budget constraints. CBO projections show interest costs rising substantially over time, reaching much higher levels in the coming decade. Historically, this is exactly the point where the mistake happens. Since 2008, the Federal Reserve has expanded the monetary base in unprecedented ways. In crisis moments, they create trillions of dollars with a few computer clicks. Each dollar created dilutes the value of existing dollars. It's like adding water to milk. The volume increases, but the concentration decreases. The American government systematically spends more than it collects. This isn't sustainable indefinitely. Eventually, either you cut spending or increase taxes or devalue the currency. Historically, the option almost always chosen is to devalue the currency. When there's geopolitical instability, countries begin questioning their dependence on the US dollar. This reduces international demand for the dollar, pressuring its value. All these factors are happening simultaneously. It's no coincidence that gold and silver are responding. You might be thinking, this is all very interesting, but how does it affect my practical life? The answer is more than you imagine. When the dollar's value decreases, everything becomes more expensive. Not just imported items, but also energy, food, housing. Your retirement, which seems sufficient, might not be anymore. If you have $500,000 saved for retirement and real inflation is 7% per year, in 10 years, your purchasing power will be only $254,000 in current dollars. You've lost half your standard of living. Stocks and bonds are denominated in dollars. If the dollar loses value, these investments can rise nominally but lose real value. It's a dangerous illusion. Many people look at the stock market rising and think they're getting rich. But if we measure in terms of gold, they're often actually losing wealth. If you have fixed rate debt, monetary devaluation can be beneficial in the short term. You pay the debt with dollars worth less. But be careful. If inflation shoots up, the Federal Reserve might be forced to raise interest rates dramatically, causing a severe recession. And here's the point that matters most. This is the cruelest impact. People who work their entire lives, save diligently, and plan carefully can see their plans destroyed by monetary decisions over which they have no control. This is why understanding these cycles is crucial. Based on historical patterns and fundamental principles, here are practical guidelines to protect your family. First, intelligent diversification. Don't put all your eggs in the US dollar basket. This doesn't mean selling everything and buying gold, but it means recognizing that currencies aren't immortal. An allocation of 5 to 10% in precious metals is a form of insurance against monetary depreciation. It's not to get rich quickly, it's to preserve wealth over time. Understand that we're in a late phase of the credit cycle. Too much debt, too much stimulus, too much leverage. Historically, this ends with a major correction. Maintain sufficient liquidity to take advantage of opportunities when the cycle turns. When everyone is selling desperately, the best opportunities appear. The best protection against economic uncertainty are valuable skills and deep knowledge. These things cannot be devalued by politicians or central banks. Economic cycles are long. What you do today might not impact your life, but it will certainly impact the lives of your children and grandchildren. Plan thinking in decades, not years. This isn't a prediction, it's a logical consequence. No one can predict exactly how or when these cycles will unfold. What's important is understanding the patterns and preparing for multiple scenarios. To navigate these uncertain times, keep your eyes on key indicators like the speed of monetary creation, because when central banks accelerate money creation, historically this precedes periods of inflation and monetary instability. Observe real interest rates, which are nominal rates minus inflation. When real rates stay very negative for too long, this encourages speculative behaviors and bubbles. Pay attention to international demand for the dollar. If other countries begin reducing their dollar reserves or trading in other currencies, this pressures the dollar's value. And monitor the debt to GDP ratio. In January 2026, this ratio is at around 120% plus, a level that many economists consider problematic for long-term fiscal stability. When debt grows faster than the economy, eventually something has to give. Some major banks and research desks have published bullish targets for gold over the next couple of years, showing how seriously institutions are taking the shift in monetary risk. For silver, some specialists see significant upside potential, considering the structural deficit that has persisted since 2021. This is the reality of the numbers, not sensationalism. To understand the current moment, it's useful to see the long-term perspective. Over the last 500 years, there have been several changes in the global monetary system. Between 1,500 to 1,600, Spain dominated with gold from the Americas. Between 1,700 to 1,800, England dominated with the pound sterling. Between 1,900 to 2,000, the United States dominated with the dollar. Each transition happened when the dominant empire accumulated too much debt, lost economic competitiveness, and could no longer maintain its currency as a reliable standard. This isn't a prediction, it's an observable pattern. The United States still has many advantages: technology, universities, capital markets, legal system, but it also has growing disadvantages: high debt, persistent deficits, political polarization, aging infrastructure. Supply chains for critical metals are concentrated geographically. When demand spikes, that concentration can amplify shortages and volatility. Recent reporting tied to the World Silver Survey shows industrial demand around 680.5 million ounces in 2024, with solar demand near 193.5 million ounces, highlighting that silver's story is not only monetary, but also industrial. Silver has had a structural deficit for 5 consecutive years as industrial applications continue expanding. If you look carefully, all the patterns are aligned. The question isn't whether there will be changes in the global monetary system, but how and when. Economic cycles teach us some fundamental lessons. Nothing is permanent. Systems that seem solid can change quickly. The pound sterling dominated the world for 200 years, then lost that position in just a few decades. Extremes always correct. When there's too much of something, debt, speculation, optimism, eventually there's a correction in the opposite direction. Preparation is everything. People who navigate crises best are those who prepare during good times. Diversification is protection. Never depend completely on a single currency, a single government, or a single type of asset. In 2025, we saw exactly this happen. When investors realized that gold and silver were entering a structural bull cycle, those who positioned themselves early captured extraordinary gains. Those who waited to be sure missed most of the movement. History is repeating, but with new nuances. If you look carefully at the simultaneous rise of gold and silver, you'll see it's not just about precious metals. It's about cycles. It's about patterns that repeat throughout human history. It's about the fundamental nature of money, confidence, and power. History teaches us that all monetary systems are temporary. What varies is only the duration and form of transition. We don't know exactly how this transition will happen. It could be gradual over decades. It could be abrupt in a matter of years. It could involve new forms of money we haven't yet imagined. What we know is that being prepared is never a mistake. When gold and silver rise together, they're telling us something important, that the current system is under stress, that changes are coming, that prudence is more valuable than speculation. It's not cause for panic, it's cause for preparation, because in the end, real wealth isn't in paper or promises. It's in your ability to adapt, to understand cycles, and to make decisions based on solid principles, not emotions. The wisdom of metals is ancient. They've survived all empires, all currencies, all crises, and they're rising together now for a reason. The question isn't whether you should pay attention. The question is, what are you going to do with this information? Because historically, those who understood these signals early didn't have to run later.